Hello and welcome to Indianomics. The Reserve Bank's Financial Stability Report has received much publicity for its conclusion that NPAs or bad loans of the banking sector have finally started declining. But there are a few risks that the financial system is facing, which the Financial Stability Report points out to, that's not received much attention. Some of the risks that the report mentions: global liquidity tightness, fiscal deficit of center and states that's rising, possible current account deficit because of the tight liquidity situation, the rising role of NBFCs and mutual funds, etc. Well, today we are going to discuss two risks that perhaps are uppermost in the minds of the Reserve Bank. The financial markets are becoming a huge risk in themselves, with large lending by mutual funds who lend on the basis of credit rating. It becomes important to have a deep bond market and sound valuation of corporate bonds, both of which may be lacking as of now, and that's what the IL&FS problem showed up. The second risk that we are going to discuss today is the large amount of NPAs generated by the MSME sector, the medium and small enterprises sector, especially by PSU banks, and especially by PSU banks which are in the prompt corrective action list. The report, the Financial Stability Report, points out that MSME NPAs in the public sector banks, especially the PCA banks, is 4 times that of NPAs of MSMEs in the new private sector banks. Now, these are two of the many risks that are brought out by the Financial Stability Report, but we're going to discuss these two since that's about the time we will have. To discuss these issues, I have with me a very eminent panel: Dr. Pranab Sen, former advisor to the Planning Commission, chief statistician and chairman of the Statistics Commission; Mr. G. Padmanabhan, former executive director at the Reserve Bank and now non-executive chairman of Bank of India; R.K. Bansan, managing director, Edelweiss ARC and former ED, IDBI Bank; and Anant Narayan, formerly a banking veteran and now professor at the SP Jain Institute of Management. Gentlemen, thank you very much for joining me. Well, first up, Anant, I'll come to you because you are the markets guy, or at least were a markets guy until recently. The problem is the market risk, and let me read out what the report points out. In the latest systemic risk survey, participants perceived financial market risk as the highest risk category affecting the financial system, while global risk, risk perception of macroeconomic conditions and others were perceived as medium risk. So clearly, financial markets are becoming a risk in themselves, and that's largely because mutual funds and NBFCs are lending on the basis of credit rating. Now, what do you perceive as the biggest lacuna over here? Why is it that market is being perceived as a risk?
Well, Lata, I think the starting point is that the secondary market liquidity is very low in comparison to the actual holdings of mutual funds and other financial institutions. Look, the total AUM, assets under management of mutual funds, is about 24 trillion rupees, of which between 13 to 14 trillion rupees is held in corporate debt. The actual monthly volumes as put out by SEBI in corporate bonds is 1.5 trillion. So, it's about your total monthly volumes are about 1/10 of the actual holdings of mutual funds. Okay. Now remember that mutual funds come out with an NME every day declaring that these are liquid and people can get out at any point in time. Now mutual funds don't run the risk because after all they are pass-through vehicles and they just have to sell in the market and liquidate if required. Yeah. And every financial institution, we know if there is a drawdown on deposits beyond a certain level, they will have problems. But it is especially egregious in this situation because banks have a lender of last resort, RBI. You can always go to RBI with your excess SLR and get liquidity if required. Mutual funds, on the other hand, and corporate bond markets don't have a lender of last resort, which means if 3 trillion rupees worth of redemptions happen one go, there simply isn't liquidity in the market to provide that kind of redemption. Now, starting with that problem, everything else follows. How do you value a book which is 13 trillion rupees, if the liquidity in the market is just not there? It doesn't matter what the credit rating agency says or what your perception of the bond market is. I'll just add one more statistic. There are about 18,000 ISINs, which is individual corporate bonds outstanding, of which only 5,000 trade in a year, in a whole year. which means 13,000 don't trade at all. So that illiquidity in the market is a basic problem which we have to resolve. The solution is not bringing down mutual fund AUM. It is increasing the depth in the secondary market.
Okay. All right. That actually states the problem very succinctly. But Mr. Padmanabhan, what is the solution? If only 5,000 of bonds are trading when the outstanding issued bonds are 18,000, how do you value? So how do you ensure they are traded? Is there an answer to this problem?
Well, as of now, the answer looks a little difficult, but let me try to a little bit amplify. I think most of the things that Anant talked about is exactly what I also had in mind. But the issue is, I would probably add one more angle to the whole thing. Out of the total issues, if you look at how much of that were actually private placements. So the real price discovery as far as the corporate debt market is concerned is a big question mark. Now, compared to that, you also, coupled with that, you also take into account the fact that, as he said, where is a lender of last resort? And there must be a secondary market. The secondary market doesn't exist. And if there is a problem, the problem just magnifies. Now, I think if you remember a couple of months ago when I came on your show, I said the moment this entire financing of the NBFC sector has moved away from the banks to the capital markets, now one must remember that these markets are much less forgiving than the banks. So the moment the problem happens, and coupled with that all these issues, then the issues get really magnified. So I think the solution to this, while this could be quite controversial, there has to be, at least for some time, a lender of a last resort facility. How that is going to be put in place is something that all of us will have to put our heads together. Whether it is going to be on a back-to-back basis, or these papers are also allowed over and above, permitted over and above an X amount of whatever Reserve Bank gives by way of acceptable paper to give liquidity to the market. All these things will have to be looked at and worked out. I don't think there are easy solutions, but we need to think about some kind of facility from the angles of the present crisis getting blown over, and secondly, the corporate debt market develop. Because unless there is a secondary market, and the secondary market, people don't come in and start trading actively, because once they are stuck, they are stuck. That's a problem.
Okay, Dr. Sen, if we have to complement the banking system, not really replace it, with the capital markets as a lender of loans, what can we do? Any solutions to the problem?
I think the point that has been made by both Padmanabhan and Anant is the issue of liquidity, right? And the question of not having a lender of last resort. The fact of the matter is that in a situation where the corporate debt secondary market practically doesn't exist, we are really talking about a bridging position. If you think of what the mutual funds do, they, in a sense, over time will develop a corporate bond market, but it's going to take time. And so one should not think of the lender of last resort as being a long-term solution. It should be seen as a bridging solution.
Okay. Well, I think we have to reconnect with Dr. Sen, and we'll do that in just a minute. The point is, Mr. Bansal, to get you in, both the regulators, Reserve Bank and SEBI, are trying to move towards capital markets as a source of funding away from banks. For instance, SEBI has this recent rule that, large borrowers, that is borrowers over 100 crore, should borrow 25% from the bond market. Is this rule too premature now? Should we wait before we force institutions, or do you think that is a very good rule to create liquidity in the corporate bond market? Mr. Bansal.
See, finally, it is a chicken and egg story. If you don't force people, then there is no market. So we have been trying, I think, RBI and government, everyone, I think in the banking system also, we have tried very hard that corporates should start borrowing from the market. But the issue is the rating. The issue is the credit quality. Finally, your market will support you if your credit quality is good. So SEBI is saying 25%, but RBI, if you see RBI, it is saying now 60% from October.
Okay.
So from where you will then borrow money if the market is not supporting? So finally, the good corporates will get it. And for maybe lower rated corporates, RBI or SEBI may have to relax it after some time.
Okay. Well, before we got cut off, Dr. Sen, sir, you were telling us that, the lender of the last resort facility can be seen as a bridging solution. My more fundamental question to you is that, we have some elements of the market developed, but some elements not developed. So how do you, solve this problem?
Lata, these are organically linked. I mean, you cannot expect every component of the whole body to come into play simultaneously. There is a sequence. And, the whole issue of the credit rating agencies, I think, frankly, to my mind, is completely overblown. These things will happen, but credit rating agencies become really systemically important only when you have a secondary market. It's really the smaller players who need credit rating agencies more than the big guys. So let's not get terribly carried away by that. There is an issue regarding governance of the credit rating agencies, regarding the manner in which they function. Those can be discussed apart. But to my mind, they're not an inherent risk in the financial market itself. Having said that, I think the really critical element is that we are now worrying about mutual funds and NBFCs as being new sources of risk. Of course they are. The fact of the matter is we had all our risk concentrated in the bank. We are now diversifying that, which is a good thing. So when we are talking about the legacy problems of the bank, let me assure you that 3 years from now, 5 years from now, we'll be talking about legacy issues in the NBFC sector. We're already starting to talk about it. These things will happen. But the fact that we've already started the process of diversification away from the banking sector, to my mind, actually reduces the overall risk of the financial system in India.
Okay. Well, Mr. Padmanabhan, very quickly, do you see it having evolved in the next 2 years? As you have more rating agencies, as you have more NBFCs, more mutual funds, and more public glare on it, do you think 2 years down the line, we could have found maybe more trading, more secondary trading, and therefore better price discovery and better valuation?
It has to be supported by somewhere the system getting assurance about the lender of the last. I completely agree with Mr. Sen saying that cannot be a permanent solution. But somewhere to trigger this market, either Reserve Bank accepting this as a part of the LCR or a part of the for your repo operations or whatever it is, there has to be some sort of acceptance of these corporate bonds at the central bank level. That's something that is very critical.
Would that be better if it was for the mutual funds?
No.
If debt and liquid mutual funds were allowed a lender of the last resort because they hold both GSECs as well as AAA bonds.
I'm saying that I have not completely thought through what should be the actual granular details, but somewhere this needs to be allowed. Today, I don't think we can even take the credit of saying that the mutual fund has grown. Mutual fund has grown because of so many other problems. And I don't completely go along with Dr. Sen that today we are completely de-risked the banking system because these risks have come back to the banking system in an indirect way. So otherwise we would have really... So this has to be all thought together, thought, and then acted upon.
Okay. All right. We have to go into a break and discuss the other major risk pointed out in the Financial Stability Report, the MSME risk. The key takeaways, hopefully some kind of a lender of the last resort facility from the Reserve Bank, at least maybe to mutual funds against maybe AAA bonds and government bonds could be a temporary solution. As well, perhaps as the size of the industry grows and there are more rating agencies and SEBI's recent rules are enforced, maybe we will have overcome the problem pointed out to us by the IL&FS problem. We're seeing some aspects of the Reserve Bank's Financial Stability Report. We just discussed the market risk thrown up by the rise of the mutual funds and NBFCs as lenders. We're now going to discuss the problem of the MSMEs. The Reserve Bank points out that when it did a granular study, the amount of MSME NPAs are much higher than system NPAs, and the amount of MSME NPAs from public sector banks which are under PCA is almost 4 times that of NPAs generated by private sector banks, the new private sector banks. Let me start with you, Anant. Right now, we also have a 59-minute loan program which the government is pushing. Do you think that we are hurtling towards disaster if already MSME NPAs are high?
Well, the numbers aren't that bad. It is higher, but not as precipitously bad as it was, for instance, for the infrastructure sector. But you can't, what you say has a grain of truth. People with the credibility of Uday Kotak and Dr. Raghuram Rajan have been warning that the next NPA crisis could be sitting inside the MSME books. Here is where it goes back to the original question. We talked about the various R's relating to public sector bank reforms, right? You have recognition, then you have recapitalization, then you have recovery, and then you have reform. Unfortunately, we are doing everything except the reform part. 10 years ago, people said that the NPA crisis was, the seeds were sown because you had phone banking and you had, people calling from Delhi and asking banks to lend to certain people, right? Now you get the fear that maybe all this pressure on putting money into the MSME sector, whether it is Mudra or whether it is 59-minute MSME loans, could be giving the wrong incentive to bankers with the best of intentions, but could be giving the wrong incentive for them to push out money to the sectors which probably require a lot more of study. So, the point is we still need reforms to come through as part of this entire process. Recapitalization is great. Money coming in is great. By the way, the financial stability report suggests that NPAs are coming down as a percentage, which is great. But we still need those seminal reforms to go through where there's a distance built between the actual administrators, the actual commercial bankers, and the masters in Delhi. You cannot have directions putting up incentives which, jeopardize the quality of the asset book and therefore jeopardize taxpayer and depositor money. Okay.
Mr. Padmanabhan, page 39 of the Financial Stability Report clearly indicates how NPAs in the MSME sector of public sector banks is higher. For instance, it's about 16% in June 2018. The MSME's NPA, whereas it is 3.9% for private banks, and for NBFCs it is 5%. Now, maybe for NBFCs the rules are not as strict as it is for banks, but when you compare private and public banks, clearly public sector banks are showing higher NPAs. Now, in this context, should we go towards this 59-minute loan with seriousness, or should we pause a bit?
Okay, couple of things. I think probably to say that the public sector banks, the MSME book is quite bad compared to the private sector bank. That is true of any kind of loans as of today. So I don't think it's a new phenomenon that's getting really flagged. And it's now about the 59-minute loan. I think what needs to be understood is that in 59-minute, a sanction or a proposed in-principle sanction gets done. In fact, one of the things that the government is worried about, and the banks and the government are in continuous dialogue on this, is how much of this loan gets converted into actual disbursements. That is actually very low.
Yes, I believe it's 35%.
Yeah, I mean, in some of the banks it's lower than that. So this is an issue. So one is to make sure that the whole process, the lethargy on the part, because the MSME sector, there is a problem in their getting credit, that's getting addressed, for which technology is being made use of. But all the due diligence still gets done by the banks before the disbursement happens. So let's not say that the 59-minute scheme is going to change the whole system for the worse. No, it may not happen. It all again depends upon that. But having said that, there is an issue here, because even these numbers, I am not very sure, has been computed after taking into account the present dispensation, which still allows 180 days for the MSME, which is incidentally going to end or has already ended in December. So if this is going to be brought back to the 90 days, there is still a stress situation which we have not taken note of. So yes, this sector is in distress, various reasons, but these will have to be handheld, because that is where I think the livelihood of millions of people depend on.
Mr. Bansal, what's your sense? The data is clearly showing that there are high NPAs in the MSME segment, 11.3%, I think, compared to the system NPA, which was, I think, 10.8. What is your sense? Do you think MSMEs can develop into a very big problem? What is the solution that you would recommend?
Finally, most of the MSME, I think you can classify into two parts. One is a smaller part, and the other one is actually reflecting mainly the corporate lending type.
Okay.
Study only, if you really see. So corporate loan book, whatever resolution is happening slowly, I think in MSME, I find a lot of OTS are happening now with the banks.
Okay.
So there will be some haircut with the banks in few cases, but I think resolution will come.
Okay.
Whatever, I think there was some delays, like for MSME payment to them from the big corporates.
Yeah.
So I think that has also got...
okay, I take your point. As the big loans get resolved, then the big corporates will be able to pay the MSMEs which service them. But more generally, do you think we should be stressing on greater loans to MSME at a time when the banking system is still riddled with higher loans? Do you think more caution is advised, as Mr. Padmanabhan is saying, that the 59-minute loan is seen as only the first step, and banks need to do greater diligence before they disburse a loan sanctioned by the software?
So I agree. I mean, banks need to do due diligence. Anyway, 59 minutes only it's only in principle sanction.
Okay.
So finally, bank will certainly take a call before disbursing the loan. So I don't think they need more caution than the large corporates. Basically, they need the full due diligence and risk management in any case.
Okay.
For the SME loan also.
Yeah. Well, Dr. Sen, I think there will be a reason why this paragraph is there in the Financial Stability Report, because the Reserve Bank doesn't want to be pushed into giving a special package for MSMEs or pushed into hastening the banks in the PCA list out of that list. This is how the paragraph on page 42 reads. To conclude, PSB performance in the MSME segment trails that of other intermediaries. This is both in terms of inherent as well as realized credit risk. In terms of newly acquired portfolio, PCA PSBs show a declining conversion rate to NPA in FY 17-18, although the rate is still high. So the argument they are making is that because they are in PCA, the rate at which they are generating NPAs has fallen, and therefore caution before you remove them from PCA. Your thoughts on this? You think it's well-advised caution?
Well, Lata, I mean, we tend to forget history, and not very, distant history as well. Remember, before the Indian banking sector went big time into financing infrastructure, their loan books were roughly evenly divided between corporates and MSMEs, and MSMEs have always had higher NPAs. This is historically true. It's in the nature of the beast. As a country, as an economic system, we need to continue with that, because those MSMEs become the corporates of tomorrow. Otherwise, we are condemning ourselves to being hostage to a small handful of corporates in the country. It's an important process. Let's not get overly carried away by the present numbers. You also have to realize that the current problems of the MSMEs is largely the outcome of demonetization. MSMEs were badly hit. Now, if we take a one-off calamitous incident and then tar the whole sector with that one, it's not fair and it's not good for the system. So I am not sure what the RBI is flagging.
Probably what the Reserve Bank is hinting is that banks should not be given targets to reach in terms of MSME loans, that bankers should be allowed to use their own commercial judgment. Yes, the 59-minute software gives you some diligence in terms of the taxes paid by a particular entity, but let us not give targets. Wouldn't that be valid, Dr. Sen?
Well, yes and no. If we are to let the commercial judgment be taken by the bankers themselves, they would never have financed infrastructure, right? Now, sometimes the government has to take strategic positions in order to serve the larger good.
Okay.
And I think it's perfectly all right for governments to do so. The point is you can't pick and choose, Lata.
Well, I'm not so sure of that, Dr. Sen. It is our tax-paid money. It is not the fisc. I'm ready to use all the money that I pay as taxes and let my tax be 50%, I'm okay. But when my tax-paid savings are forced to go to places where the commercial banker is not very comfortable, I would be a little uncomfortable with that kind of a government dispensation. Unfortunately, we are out of time. We will have to spend more time on how the MSME sector has to be handled. All that the Financial Stability Report is flagging is that there is a risk. So before we start giving big targets to be lent to this sector, let us pause. And I think that's worthwhile caution. Thank you very much, Dr. Sen, Ananth, Mr. Bansal, and Mr. Padmanabhan for participating in this call.